your cycles are all wrong in here. They're actually not. They're almost perfect. If this is a low cycle, and this was a high cycle here, and there's the highest price in that point, that would suggest to me that going forward in the future, I should find a buy trade somewhere in here after that price turns around here. And if that's the case, I should find a sell trade somewhere around about this price onwards. And if that's the case, I should find a buy trade somewhere around about this cycle onwards. Is that the case? Does this buy trade here perhaps predict this buy trade here? Does this buy trade here perhaps predict that sell trade into the top edge here? And does that sell trade perhaps predict this buy trade into this bottom edge here? Or is it just coincidence? Is it possibly just coincidence? Well, of course, it's possibly just coincidence. But now that I've shown you probably well over 20 examples of it possibly just being coincidence, could it be that it's a little bit more than coincidence? Could it be that there is perhaps a little bit more than just coincidence coming into those cyclical narratives? Is that a possibility, is what I'm asking. And if it's a possibility, could it be something? In other words, did my buy trade predict that response there? Did I just tell you that this would be the buy trade here? Did I tell you that based on that there's a chance that that's going to be the buy trade? Did I tell you that in advance? Could it been for another reason, or is there a possibility that there was a real money prediction that that was going to be a buy trade cycle coming in at that point? Is it because this swing low here told me to buy it? No, it's because of other things. But is it a good starting point? That's up to you. If you don't think it's a good starting point, don't use it. But when these market maker cycles impact in price areas like this, I can look at that from a theta point of view as part of the Black-Scholes type model and say, well, realistically, theta-wise, I need to try and defend this because X period of time's passed, the price has traveled Y direction, and I want to make sure that I have an opportunity to look at that as a real money theta question. Cycles, we're not talking about amplitudes, we're talking about frequencies. Amplitude from the middle to the high, from the middle to the low, that's not what these cycles are here for. That's what measured moves are there for. But in terms of theta, the frequency, that's what I'm interested in from these cycles, is the frequency. Because frequency brings volume. Amplitude brings volume. Frequency plus amplitude bring more volume. That's my point I was trying to make to Jack. So if I have a certain frequency, like here, that's going to bring volume because there was the frequency between the volumes. So that frequency will bring volume. And the interesting thing is the price will bring the amplitude, and that's the price that brings the amplitude. So if I get frequency and amplitude at the same time, that is a wave. That's got to be a wave. It's a market maker cycle. And it's the same as what we were talking about there. So we get the liquidity, we get the frequency. And because of that, we have a market maker response to that. And that's when we see these types of outcomes, these types of trades developing at that price. And we have to still fit it in. There still has to be a reason. But we know that there is a high probability that the market maker will try and take the market. At that stage, the market maker will try and take the market offered. And if they can take the market offered or bid at that stage, you've got your market maker frequency.